Options terminology. We are going to go over the options terminology that you need to know, and I'm going to specifically go over options terminology in regards to contract types and the contract prices. So the thing that gets people really tripped up, especially if they're coming from futures or Forex, is the many different terms that you need to know when it comes down to the contracts of options. So with contract types, there are specific words that you need to know to understand what contract you need to buy. And with contract prices, I will explain the different terms that relate to the price of the contract. But before I get into the terminology, one thing that you do need to know, if you don't already, is the stock market hours. What hours are we able to trade these contracts? So the stock market hours are 9:30 a.m. to 4 p.m. Eastern Standard Time. And that is something that you're going to need to know. It is very important. Let's get into these terms regarding the contract type. So I have color coded everything so that could be easy to follow. And I'm using a screenshot from the Amazon options chain on Webull. We're going to get deeper into Webull as we go through the course. But this is what the options chain looks like for an Amazon contract. And as you can see, there's a lot going on. There's a lot of numbers on the screen, a lot of words, and we're going to break it down. So in green, that is called a call. So everything on the left side are the calls. All those prices, whether it's red or green on Webull, is a call. Everything to the left of, at the top where it says options chain, everything to the left of that are calls. So what is a call? A call option gives the owner the right to buy a specific number of shares of stock at a predetermined price. In layman's term, a call is the name of the contract that you buy when you believe the stock price is going to go up. So if you believe the stock price is going to go up, you would buy a call so that you can make money on that ride up. In this course, we are only going to be buying calls. Now in the red box, I have identified the word puts. Everything to the right of the options chain center is puts. Those are puts prices. Those are puts contracts. A put option gives its owner the right to sell a specific number of shares of stock at a predetermined price. Basically, a put is the name of the contract you buy when you believe the price of the stock is going to go down. So it's the opposite of a call. You can make money both ways in stock options, which we love. So if the stock is going to go down in the short term, you'd want to get a put so that you can make money when it goes down. However, in this course, I'm not going to be talking about puts. I'm not going to be teaching you how to buy puts. I teach that with different strategies in my Market Money University course. This center yellow box, you see these prices with a dollar sign in front of it. That is the strike price. And there's different strike prices for every single stock option. The strike price is the price you'd pay per share if you were to exercise your rights on an option. This is the price that you will see that will always have a dollar sign in front of it. If you were to exercise your option, which means if you were to carry out the contract of your option, this is the price you would pay per share, because a options contract represents 100 underlying shares. So basically a contract is saying that you have the right to buy or the right to sell, but you don't have to. So that's how that goes. It gets deeper than that, but for this course, we're going to leave it at that. Just know that the strike price will always have a dollar sign in front of it. And on the Webull trading platform, it is in the center of the options chain.